All right, guys. Well, hey, we are on to our next session, session number 4 here at Note Camp Commercial, and we're honored to have CPA Thomas Castelli join us here today. Some of you guys may recognize Thomas from when he appeared on the Note Closer Show podcast a few weeks back. A really great episode. A lot of people really enjoyed. Getting quite a few downloads. Actually, it's today, which is kind of nice to see too, huh, Thomas?
Yeah.
Uh, hey, glad to have you here, man. Thanks for taking time out of your hectic schedule. I know you've been very, very busy. A few days off for the wearies. You're rocking and rolling, knocking some things out, and working with a lot of investors. And that's why I like having you on here, because you guys are working with a lot of people in different parts of the country, helping them with their tax planning strategies. And so, honored to have you on here. I know you've been working on some stuff here specifically for this presentation. So, we're going to hold if you've got questions, we'll hold them to the end so Thomas can get through everything, and we'll have plenty of time at the end for Q&A. But without further ado, our buddy Thomas Castelli, CPA. What's going on, man?
Not much. Just it's a Friday. I thank you for having me on today. And Fridays are always good. The easier day of the week, even though there are no days off.
So you have a presentation you want to pull up there?
Yes. Let me go ahead and pull that up.
There you go.
Here we go. We're going to hit the present button. Present. And we are here.
Golden. Good stuff.
All right. So my name is Thomas Castelli. I am a tax strategist for a firm called the Real Estate CPA, where we only work with real estate investors, work with investors across the country in all sorts of investment niches, including single-family, multifamily syndication. We have our largest client is a private equity fund, and we, of course, work with plenty of clients who do note investing from all different areas of the spectrum. And in today's presentation, we're going to go over tax planning for commercial note investors, and we're going to discuss how to minimize your tax liability primarily on interest income. As you'll see, this is going to be a big topic. So without further ado, we're going to just kind of jump. Well, actually, we have to get to the disclaimer first. So this presentation is meant for informational purposes only and should not be taken as tax, legal, or financial or other advice. At the end of the day, as taxpayers, we all have different facts and circumstances. We all have different income sources from different places and in different amounts. Some of us are married, some of us are single, and some of us have investments. And all of this plays into your tax picture. And so what this presentation is meant for today is to inform you of these various strategies that are available to you, and then so you can go and have that conversation with your tax, financial, and legal advisors to see if it makes sense for you to implement. So what we're going to be covering today we're going to be covering how interest is taxed. We're going to be covering being in the business of note investing, what that means and how that impacts your tax situation. We're going to be covering standard tax mitigation strategies. These are going to be basic strategies that pretty much anybody can implement relatively effortlessly. We're going to go into some advanced tax mitigation strategies that are a little bit more complex and are not going to apply to everybody, and will be a little bit more difficult to implement. We'll be going through a Q&A session and then share some of my contact information with you guys. So first off, how is interest income taxed? So interest income is generally taxed as ordinary income, up to 37%. So it's your standard tax brackets. Now, because interest income is considered ordinary income, it is the most difficult type of income to shelter. It's akin to your W-2 income, to your business income from, say, a consulting practice or any other type of business for the most part that you run outside of rental real estate. This is partly due to the fact that, so the reason why it's so difficult to shelter is due to the fact that for most note investors, if you're just casually in the business of, if you're just casually note investing, the only expenses that you can offset your interest income with is interest expenses, unless you're in the business of note investing, which we'll discuss a little bit later. And what I mean by interest expense is, let's just say, for instance, you go to the bank and you take out a home equity line of credit, HELOC, on a primary residence or perhaps one of your rental properties, and you get that at 4.5%, let's just say, and you know what, I'm going to go take that and invest in some notes. I'm going to have a note that's at 8%. I'm going to take the spread. You can take you're going to have your interest income on the note. You're going to be able to take that interest expense, so the interest you're paying on the HELOC, against your interest income. So it's going to reduce it. But generally, for a lot of people, that's going to be the only expense you can take against your interest income, which of course causes some problems. Now, For individuals with modified adjusted gross income, also called MAGI, over $200,000, and for married couples with a MAGI over $250,000, you are also subject to an additional 3.8% tax called the net investment income tax on your interest income, as well as your capital gains income and rental income as well. But specifically here for note investors, we need to be concerned that it hits your interest income. Now, if you're in the business, quote unquote, of note investing, you can be subject to an additional 15.3% self-employment tax. So as you can see with this picture, your taxes can easily climb up pretty high. And we didn't even mention state taxes. Now, where Scott's located in Texas, there is no state tax. So you're not going to have to worry about that there. But in a lot of other states, there is. Now, we want to talk about, the first thing I want to talk about is the taxation of market discounts. And a market discount is basically considered the excess of the redemption price, so the stated price of your note, at either at the sale of the bond or at maturity. Basically, that price less your adjusted basis. So basically, your purchase price of the bond is the easiest way to think about it. Now, it would be easy for one to believe that this market discount would be considered a capital gain. But that's not necessarily true. Part of your gain may be subject to the ordinary income tax rates, again, up to 37%. If the note is purchased at a discount, the gain to the purchaser upon repayment of the note in full is interest income. So in other words, if you hold the note until its maturity, the difference between the purchase price of the note and the ultimate payment upon maturity is going to be considered interest income. So for example, you buy a note with a face value of $100,000 for $70,000 and hold it until maturity, that $30,000 in profit is going to be considered interest income and not a capital gain. And capital gains are taxed at 15 to 20%, and interest income, again, taxed at that 37% rate. So gains realized on the sale of a market discount bond must be recognized as interest income to the extent of the accrued market discount, and any remaining gain will be taxed as capital gains, again, at that 15 to 20% rate. The total amount of this discount is multiplied by the number of days the taxpayer has held the note at the time of sale, divided by the number of days after the date of acquisition, to including the maturity date. We're going to have an example here on the next slide. So, for example, if you were to purchase a note with a stated principal amount of $1 million for $700,000 in the secondary market, at the time of purchase there are 500 days left until the note reaches maturity. How's that going to be affected? Well, first, if you hold the note until maturity, just like the example we showed the previous page, that $300,000 of quote-unquote gain is really considered ordinary income, taxed at the ordinary income rates. Now, if you were to sell the note before maturity, the gain, but you held it for 200 days, then the first $120,000, and again, that's taken by that equation, the amount of days you held the note divided by the total amount of days until maturity at the time of purchase times the discount, that $120,000 is going to be considered ordinary income. Now, any amount above that $120,000 will be considered capital gains. Now, there's a planning opportunity here. Just want to stop at and explain that you have the ability, the option, to elect to have that discount amortized over the course of the time you hold that note rather than at full at disposition. So again, if we just go back to the example, that $300,000 gain you see right here, you could, instead of recognizing it all in the year you sell it, you can instead have it amortized over a few years. So you're not taking that entire amount of income all in 1 year and having to pay that big tax. And why would you want to do that? Well, as we mentioned before, you're looking at that 3.8% net investment income tax on some of your, on some of your income if you're above $200,000 if single or $250,000 if married. So you may sometimes choose to amortize this out and spread out your income from these notes in order to get below those thresholds. And other times, it's not just about the net investment income tax. It's about the progressive tax system. Again, 37% is that maximum rate, but there are lower percentage rates you could be taxed at. And sometimes by spreading it out, you can prevent yourself from entering one of these higher tax brackets and having to pay more tax. Now, note modifications. So according to the IRC, the Internal Revenue Code, a modification is considered substantial if the legal rights or obligations being changed and to the degree in which they're being changed are economically significant. It is considered to be significant if the modified yield of the unmodified yield varies by the greater of 25 basis points, so a quarter of a percentage point, or 5% of the yield of the unmodified yield. Now, I know that's a mouthful. This is, again, some complicated accounting speak here, and we're going to get past this really quickly and start getting to the fun stuff in just a moment, so just bear with me here. So, for example, if you were to hold a note with a 10-year term at a 10% interest rate payable annually and has a $100,000 payment due at maturity, but at the end of the fifth year, the parties reduce the amount payable at maturity to $80,000, then this is a significant modification because the regulations say that the yield of the instrument has now been reduced to 4.332%. Thus, this is deemed an exchange as a modification. So if a note is significantly modified, the investor will have a gain or loss that equals the difference between the issue price of the note, the original note, right, and the investor's of the new note, and the investor's adjusted tax base of the old note. Now, it's complicated right there, some accounting talk, but basically it's the purchase price, essentially, of the note. Note modifications continued. Other features that would indicate a significant modification can include deferrals. What is taken into consideration is the length of the deferral, the original term of the note, the amounts of the payments deferred, the time period between the modification and the actual deferral payments. Now, the IRC does give a safe harbor that says if one or more payments are deferred but are still unconditionally payable in that period, in other words, the year, then it's not significant modification. So, for example, let's say you purchase a note and you allow, I don't know, say an office tenant, let's just say, I don't know, you have, Dollar General as your tenant. You say, you know what, you don't have to pay the note for the month of August. As long as they have to still pay that note, and as long as that payment's due by the end of the year, then it will not be a significant modification. However, if you are to extend it out beyond that year, beyond that period, then it may be considered a significant modification. You may have a taxable event. Now, I can sit here all day and talk about how notes are taxed, but really what you guys want to know about is what you're going to do about it. So before we jump right into that, there's one last thing we have to talk about that I forgot in this slide. So if you are in the business of note investing, meaning you're doing this on a regular basis, you may be considered a dealer. And again, a dealer is defined as a merchant of securities, whether an individual, partnership, or corporation, with an established place of business, regularly engaged in the purchase of securities and their resale to customers, or one who regularly purchases securities from or sells securities to customers in the ordinary course of doing business. So if you're just doing, 1 to 3 notes a year, chances are you're not in the business of note investing. You're not a dealer. But if you're doing a significant amount of transactions and you're carrying on, you're treating this like a true business, meaning you're doing advertising, you're doing marketing, you might have some staff, then you might be considered a dealer. And when you're a dealer, there is a few things you have to worry about. When you're a dealer, pretty much all of the income, all of the gains you make on sale are considered ordinary and taxed at the 37% rate. Now, I think for people who are maybe in the fix and flip business, it's a little bit more significant. But if you're in the note investing business, a lot of your income's already going to be taxed at that ordinary income rate. So it's not necessarily as big of a deal, but it's still something to be aware of. Now, also, when you're a dealer, your income might be subject to an additional tax, that 15.3% tax, depending on your other sources of income. The self-employment tax is only charged on income up to $132,900. So if you are a dealer, but you have another business, or maybe you work a W-2 job and you just have a significant note investing business, then you may be paying all of your self-employment tax or majority of your self-employment tax already through those sources. But what do you do if you don't have other sources of income and note investing is your only business? How do you mitigate this 15.3% tax, the self-employment taxes you have to pay? Well, what you have to do is you have to open up an S corporation. What an S corporation allows you to do is allows you to divide your earnings between wages and owner distributions. And wages are subject to self-employment tax, but the owner distributions are not. So, give an example. Let's just say that you earned $100,000 in income from your note investing business and didn't use an S corp. You'd be paying $15,300 in self-employment tax. But by using an S corporation, you can pay yourself a $40,000 wage. And remember, self-employment tax is only paid on the wages, and you only pay $6,120 in self-employment tax, saving yourself $9,180. So that's just an example of how an S corporation can help you mitigate that self-employment tax. And again, not everybody's going to be subject to the self-employment tax. You're only going to be subject to it, mainly if you're in the business of real estate investing, of note investing, and that you're not earning more than $132,900 from another business or from another source of income, such as employment. So now we're going to move on to the real meat, the tax planning opportunities. The bottom line here, before we wrap up, the big point I wanted to make in how interest is taxed is that a lot of it, in most cases, is going to be subject to ordinary income tax rates of up to 37%, and you're not going to be able to simply get that favorable capital gains rate of 15.3%. And we're going to go into some opportunities on what you can do to help mitigate that tax. So if you are in the note investing business, you are allowed to deduct your expenses against your income. Now remember, if you're just doing a few notes per year, you're not going to be in the note investing business, which in some ways is favorable because you get to dismiss that self-employment tax completely, but you cannot deduct your expenses from it. You can only deduct your interest expense. But if you're in the business of note investing, you can deduct things like your home office, your mileage, your advertising / marketing, your legal and accounting fees, your wire and bank fees, office supplies, business meals, travel, pretty much any other fees associated with your business, perhaps the loan servicer, that are now tax deductible. Now, there's two of these that I want to touch on with a little bit more detail, and that's going to be the home office. So the home office is a good, I'm going to move this off my screen. So a home office is good because the first thing a home office does for you is it establishes your home as a place of business. So if you don't have an office that you work out of, you can receive a deduction for the business use of your home. The second thing a home office does is it allows, because now your home is a place of business, you can now deduct the mileage. So if you have to travel to the bank, you have to travel to, to meet with your attorney, to go meet with your investors, to meetups, etc., local travel around your local market, your mileage will now be tax deductible. The standard mileage deduction for 2019 is 58 cents. So if you do a lot of driving, make sure you have a home office. You're going to want to make that. You want to make that travel tax deductible. But paying your kids, this is another perk of having a business, is that you get to pay your children, and there's some tax advantages to doing so. So having a business, you can pay your children, and the amount you pay your children is a tax deductible expense to your business. It's considered a wage or independent contracting expense. It is also tax-free income to your children as long as you pay them less than $12,000 for the year, which is the current standard deduction. And B, they're employed in a business owned solely by one or both parents. So with that said, this is something, if you do have children out there, you will want to consider hiring them, because you could pretty much get a tax deduction and then transfer them money tax-free. So something to consider. Now, business travel and education, this is often a big one, right? So educational expenses, so books, courses, seminars, conferences, those type of mentorship programs, those type of events, or those type of expenses are only deductible if they're to improve or maintain skills in your current line of work. So in other words, if you haven't started a note investing business yet, you really haven't started purchasing any notes, these expenses will not be tax deductible. And remember, in order to deduct these, you need to be in the business of note investing. So you need to be doing this. You need to have a substantial note investing business to make this happen. Any expenses you incur prior to opening up your business, quote unquote, will not be tax deductible. Now, business travel expenses are deductible, so airfare, transportation, lodging, meals, etc., as long as the business trip is outside of your quote unquote tax home, which is generally the 40-mile radius of your principal place of business. So if you don't have one, it's probably going to be your home office. But if you have an office, generally going to be in your office. Now, and also it has to be primarily for business purposes, which means 50% or more of the trip is for business. So if you went away, let's just say, for example, for a 5-day trip, and you spent 3 days on business, but 2 days at the beach, you'll be able to deduct your expenses for those 3 days, including the airfare and transportation. Now the lodging, so the hotel expenses and the meals on those 2 days, which are not business, will not be deductible, but you will be able to deduct that airfare, those transportation costs to and from the location, because of the fact that is over 50% used for business and it's primarily a business trip. Now, there is another deduction here to talk about on the business side, and this is the 20% pass-through deduction for people who are sole proprietors. They have a disregarded entity, maybe like an LLC, which you're the sole member of, partnerships and S corporations. If your taxable income is less than $157,500 or $315,000 if you're married, you're going to get a 20% deduction of your business income. That means if you have, let's just say you are a business and you have $100,000 of business income from your note investing business, you're going to be able to deduct 20% of that right off the top. There is a phase out, and that phase out starts at $207,500 if you're single, and $415,000 if you're married. But if you're above those thresholds, you will get some form of this deduction. It's just going to be subject to limitation calculations, which are pretty complex, mostly just done by tax software at this point where we are in society in 2019, 2020, where technology is so significant. So we're not going to cover those today. Just know that if you're above those thresholds, you will get some form of this deduction. It may be less than 20%. And there's not much you really have to do to get this deduction. If you're in business and you own one of these entities, you're just going to get it. It's just going to happen. Now, there might be some tax planning opportunities to get your income below these thresholds, which we'll get into in a second. But again, there's not really much you have to do to get this. You're just going to receive it. So we're going to touch on some standard tax minimization strategies. These are going to be the low-hanging fruit items, the items that pretty much anybody can implement relatively effortlessly. You probably have heard of all of these before. It's not anything extravagant. We're looking at contributing to a company 401k or a solo 401k. So if you work for a company, you have an employer, you can contribute up to $19,000 to your 401k, which will reduce your taxable income by $19,000 and could help you get below those thresholds we just talked about in the slide previously. Now, if you're self-employed, you can contribute up to $56,000 to a solo 401k. So it's a little bit more advantageous if you're self-employed. You can contribute a little bit more. You could also make charitable contributions. You can make charitable contributions up to 50% of your AGI. Now, most people won't make those high of charitable contributions simply because that money leaves your pocket. At least with the solo 401k or the 401k, that money is going to be returned to you at some point in the future. You can also move to a state with a lower or no income tax. For example, Texas and Florida. Now, there's a few other states that have no income tax. I didn't list them here, but that's one of your options. You can also use tax credits. There's energy credits. There's solar energy credits available to you. I believe the Tesla credit or the electric vehicle credit is still available for a portion of 2019. You can use that. And the benefit of a tax credit is it reduces your tax liability. So the actual taxes you have to pay dollar for dollar. So these are just the basic things. Now, the one big thing I think for majority of note investors out there, whether you're commercial, residential, or otherwise, if you're just doing it casually and you're not going to create a huge business out of it, the most ideal entity or the most ideal vehicle to use for the notes are going to be your retirement accounts, your self-directed IRAs, your self-directed 401ks, and your solo 401ks, because these completely shelter the interest income from tax, which really makes these retirement vehicle accounts, again, the ideal investment vehicle for no investors. Now, you could fund these accounts through existing IRAs and 401ks. But again, if you can invest through these entities and you're not going to through these accounts and you're not going to be doing it on a huge scale, that's your best bet. And just one more thing to touch on, interest income is generally going to be exempt from the unrelated business income tax, UBIT, which also makes notes and note funds an ideal alternative investment for retirement accounts. Typically, one of the more smoother investments, if you're looking to get out of it, rather than a syndication or a rental property investment, where you're going to have to be, where you may be subject to UBIT. Now we're going to go into the advanced strategies here. These strategies are a little bit more complicated, won't work for everybody, but are important to understand and may help you. And one of the things I want to note here is that in order to change your taxes, sometimes you need to change your facts. So sometimes you need to change what you're doing. Sometimes changing the way you're going about doing business, changing certain actions that you're doing in order to achieve these big tax benefits. The first one I want to talk about is the real estate professional status. If you're a note investor, you may also be a real estate investor. You might also invest in hard property. So the real estate professional status is highly coveted by real estate investors because it allows you to take unlimited passive losses against your ordinary income. So in other words, your interest income, your W-2 income, your business income. And passive losses are generated by holding rental real estate. So we're going to get into that in a second. To qualify as a real estate professional, you must work at least 750 hours in a real property trader business, and more than half your total working hours must be in a real property trader business. So for example, if you work 750 hours in a real estate business, but have a full-time job, which full-time jobs are generally considered to be 2,080 hours, you will not qualify because you did not work more than half your total working hours in a real estate trader business. And something to note here, note investment businesses are generally not considered real property trader businesses. You're usually considered to be in the financing business and not in a real estate business. So the thing to point out here is that you may have to come up with a strategy where you're working at least 750 hours and more than half your working time in another real property trader business to take advantage of these strategies. Again, to change your tax, sometimes you need to change your facts and do things you don't, and do things that may not be necessarily in your wheelhouse. So businesses that do count towards the 750 hourly requirement we have here are development, construction, acquisition, rental, management, and brokerage of real estate. Many people who are looking to achieve this status will get their real estate license and practice as a real estate agent or perhaps a property manager in order to reach this requirement. Now, there's a second part of this requirement, and in order to actually take the losses against your ordinary income, you must materially participate in the activity. In other words, your rental portfolio. Again, to not only would you want to qualify for this status, but you actually want to build out a portfolio of rental properties so that you have passive losses. And we'll discuss on the next slide, I believe, how to increase those losses to make this strategy work. And to meet this material participation requirement, is generally done by spending 500 or more hours in your rental business, and these activities include showing the property for rent, taking tenant applications, screening tenants, preparing and negotiating leases and other rental agreements, cleaning and preparing units for rent, including in the initiation time you spend, so in between cleaning up units, doing repairs or improvements yourself or arranging others to do them, hiring and supervising a resident manager, purchasing supplies and other materials for your rental business, inspecting the property, responding to tenant complaints and inquiries, collecting, depositing rents, evicting tenants, writing and placing advertisements, and creating and maintaining a website for your rental business. So all of this is needed for you to qualify as a real estate professional and be able to take your passive losses against your ordinary income. So here's a good planning opportunity here. You can have your spouse qualify as a real estate professional. So maybe you're full-time in the note investing business. That's your bread and butter. That's what you do. But maybe your husband or wife is in the business, in the rental real estate business, or maybe they're a broker, maybe they're a property manager, maybe they do any of these other tasks that can get you to qualify. If they can qualify as a real estate professional, then because you are married, you both qualify as real estate professionals. So just as a quick example, let's just say that you are the note investor. Or say that I, in this example, I'm the note investor, and I have, I don't know, let's just say I have $500,000 in interest income or ordinary income, however that I derive that from my note investing business. But my wife, she is, excuse me, she is a broker, and she manages a portfolio of rental properties that generates passive losses each year. Those passive losses, let's just say they're $100,000, they can reduce my $500,000 in note investing income, and now I'm only paying $400,000 in income, right? In taxes, rather. So it reduces it, and those rental losses can be increased significantly depending on how much property you have. And in some cases, we've seen clients reduce their tax liability to zero. That's right, zero, by using this strategy. Now, you would want to combine this strategy with cost segregation studies on your rental portfolio, because you can get the components of your buildings broken down to 5, 7, 15, and 27.5 year class size. If you do residential real estate, it's going to be 39 years for commercial real estate. And generally anywhere between 20 and 30% of the building's value can be broken down into this 5, 7, 15 year property, which is depreciated faster and increases your depreciation expense and thus increases your losses. Now, the Tax Cuts and Jobs Act introduced 100%, or rather extended 100% bonus depreciation on property with useful life less than 20 years. So if you want to take an example, let's say you have a building that's worth $1 million and you have a cost segregation study done that results in 20% of the property being reclassified into 5, 7, and 15 year property. That would increase your first year of depreciation by $200,000. So that means you're going to get a $200,000 deduction that, again, if you qualify as a real estate professional, that you can use to offset your ordinary income. I really feel that this is the most powerful strategy for real estate investors out there, the combination of cost segregation, of real estate professional and cost segregation, and with the ability to have your spouse qualify for this status, you can mitigate this. This is going to be the most powerful strategy for you to mitigate that ordinary income. The next one we want to talk about is a CCorp blocker and offshore trusts. So as of 2019, the tax rate for a C corporation is 21%, much lower than that 37% maximum tax rate as an individual. And because C corporations are not pass-through entities like a partnership or S corporation, meaning if you have a partnership or you have an S corporation, the income is going to flow down through to your individual tax return via Form K-1, and you're going to be taxed at your individual tax rates. Again, that 37% number, I know you're going to hate that number, but it's 37%. Meanwhile, for the C corporation, that does not happen. You can keep the money in the C corporation and only be taxed at 21%. So if you don't need the money immediately, this is definitely a good strategy. And there are other ways you can tap into the money of the C corporation. The owner of the C corporation can tap into the money tax-free via a loan from the C corporation at market rates. So in other words, the C corporation can issue you a loan at, let's say, the market rate of, 4.5%. And that's how you can get money out of your C corporation. So you're saving yourself from being taxed at, say, perhaps at 37% rate, and you're still able to tap into that money via loan. Yes, you have to pay some interest, but you're paying that interest to the C corporation, which, again, you own. Now, the owner can also pay out dividends, although that dividends are taxed at the individual level. That can be controlled to limit the amount of income you have for the year and enter into higher tax brackets. So, again, you can leave the money in the S corporation, take some out either via loan or via dividend. Next, we have offshore trusts, which we're not going to go too much into detail with. Offshore trusts really only start making sense when you get into the millions of dollars of income, talking about 2 to 5 million. But basically what an offshore trust allows you to do is allows you to generate income tax-free until you bring it into the U.S. It's most akin to a 401k or another retirement account in which you're allowing your money essentially to grow tax-free. But then when it's time to bring it into the U.S., you're going to be subject to the taxes. So it's another planning opportunity. If you're going to do this, you should definitely talk about it with your attorneys, your estate planning attorneys if you have one, and your financial advisors as well. It's one of the more complicated strategies here as well. The CCorp blocker is pretty complicated in and of itself. Next one is investing in oil and gas. This one's a little bit risky. It may not be in your wheelhouse, but again, like I've said before, change your tax, you need to change your facts. So taking a working interest in oil and gas investments can provide you with an ordinary loss in the first year of the investment, generally through 100% bonus depreciation, because you'll have the opportunity, or the partnership in which you invest in will have the opportunity to appreciate much of the oil and gas investments equipment in that first year, and thus it offsets your ordinary income. In this case, for note investors, your interest income. Now, working interests in these investments carry risk because you will be a general partner subject to unlimited liability. However, there are some opportunities that exist out there where you can revert your general partnership interest into a limited partnership interest, taking much of your risk off the table after the first year. And finally, the last one, we have a lot of clients actually who explore this idea but never quite pull the trigger when they realize what it really takes to implement it. But I want to let you guys know about it so you're fully aware of your business, so you're fully aware of your deductions. So under Puerto Rico Act 22, bona fide Puerto Rican residents are exempt from taxes, right? Exempt, so it means 0% on dividends, interest income, and capital gains. And they're also only subject to a 4% corporate tax rate. However, to achieve this status and get here in Puerto Rico, you must be a bona fide resident of Puerto Rico that lives there for at least 183 days or more. And other factors that will also help indicate that you're indeed a bona fide Puerto Rican resident includes where you have your bank accounts, your connections to the U.S. Do you have your children under the age of 18 living in the U.S.? Do you have businesses and bank accounts still located in the U.S.? To what extent are they located? Again, this is not exactly some cut and dry stuff here, something that have to be analyzed. Where you register to vote. If you're a true bona fide resident of Puerto Rico, you have to be voting in Puerto Rico, right? You have to have your voter's registration in Puerto Rico. Your mailing address for official documents should also be in Puerto Rico. See, and this is usually where we start to scare people. When they start to realize that their entire lives, you really have to move to Puerto Rico. You really have to move there. One more caveat here. Pro rata allocation. For the investments prior to being a Puerto Rican investment resident, only the portion of appreciation that accrues while you're a bona fide resident of Puerto Rico is considered Puerto Rican sourced, and thus eligible for the exemption on your dividends, interest income, and capital gains. The portion that accrued while you were a U.S. resident or a resident of some other country, if you're a resident of some other country listening to this, will not count. You have to pay capital gains and interest or just taxes in your state or in your country, rather, of residency. So that concludes the portion of this presentation. If you're interested in getting in contact with me, you can connect with me on LinkedIn. My LinkedIn link is right here. You can also catch us on the Real Estate CPA podcast, where it's out on iTunes, Spotify, Stitcher, SoundCloud, iHeartRadio, etc. If you're interested in working with us, you can head on over to that website, hit the Become a Client page, fill out the web form. We'll get you initial consultation within 1 to 3 days.
So, all right, hang on a second. You're not going anywhere. We still got quite a bit of time. We're about 35 minutes with you here. Okay, you ran in through that. It's always surprised we get a few people come back and ask questions about it stuff. But let's dive into some of the first couple questions here. I think Levi had a question here. He goes, once again, can you recap what makes you in the business versus an investor when it comes to self-employment tax? What does that break down again?
Okay, so yeah, it's not any one factor that makes you in the business. It's a majority of factors taken into consideration. The most easiest one for most people, there's no price line test, but the easiest one for most people to kind of tell for themselves is the number of transactions you're doing. If you're doing, if you're doing multiple transactions, buying and selling multiple notes per year, and it's not like you're just buying a few notes and then selling them off casually. You're doing 10 transactions, you're going to be considered a dealer for the most part. Also, to the extent that you're operating it like a business, right? If you're spending a significant amount of money on advertising, you're putting in infrastructure, you're setting up entities to do this in, you're making I'm just trying to think of all the different scenarios. I mean, there's a lot of scenarios. Where you're raising capital, right? If you're raising capital, if you're getting significant bank loans for this, if you're using financing, these are things that are going to indicate whether or not you're a dealer. Now, your CPAs, your tax attorneys, your other advisors may have different opinions on this. There's a lot of varying opinions on what really makes someone a dealer because there is no bright line test. So that's something you'd have to discuss with them to figure out if you are one. Good
question here. Levi also says, can you both be in the business and invest your IRA in notes without over contributing to your account on a part-time or part-time due to buying notes from the same sources for your note business buys from?
That's a good question. I would say that generally speaking, your IRA is going to be considered a separate entity from you. It is a trust. So what you have going on in your IRA shouldn't necessarily bleed over to what you're going on in your business. So your IRA should still be exempt from that UBIT tax.
I'm sorry, prohibited transactions of PT. Yeah, I mean, that's what I'm saying. As long as you're not doing like we had Nathan Long on earlier this morning talking about prohibited transactions. You can't go with people up or down or their spouses or the side to side. So as long as you're doing normal transactions, as long as you're not buying that note from your entity that you're a principal on, or that's not a prohibited transaction. So yeah, good answer there. All right, let's see here. Sherry asked a question. If your kid earns an income from your company, he or she will need to file a separate tax return, and can you still declare as a dependent on your tax return 1040?
Okay, so if you do pay your child and they're under the age of 18, you will not have to file a tax return for them if these two things are met. If you're paying them under $12,000, because they have the standard exemption, a tax return is not required because they don't owe any taxes. And B, that they're working for you in a business that's owned by either you and or your spouse. Because if they're being paid like that, then they're not going to be subject to that self-employment tax, either the FICA taxes. So yes, you could still qualify, claim them as a dependent, and no. Yes, you can still claim as dependent, and no, you don't have to file a tax return for them.
Okay, good. All right, let's see here. Mary Ann, if you are in the business and using your IRA, is that disqualified or prohibited?
So if you're using your IRA, generally speaking, it's going to be not qualified or prohibited if you're doing it separately from your business. Like you're not intermixing your business transactions with your IRA transactions.
Yeah. So here's how we do this thing. So I think we can all agree that I'm in the note business, right?
Yeah, for sure.
And I have IRAs. Well, if I'm buying a portfolio of notes and I can't have that loan contract say all to me, I've got to basically, if I want to put my IRA into one or two of them, I have to basically have two separate contracts where my IRA is purchasing it from, let's say, direct source. Okay, so if I'm going to have them fund two are coming from my IRA and going there. Now I can partner. If I want to, I can partner personal funds and part of my IRA funds, but I'm still going to have to be a third party person. I can't do all the work. I can't be doing stuff. I've still got to have the separate people. It's like buying a house. If you can use personal funds and IRA funds, but you can't do any of the work. You can't receive any of the personal benefits of it. So it's all that money's got to go back into, or that ratio has got to go into my IRA. So hopefully that answers your question there for you. Lan asked the question, if we buy and sell notes under solo 401k, then are we subject to the tax?
No, generally no.
Okay. Dan Nicholson, Diesel Dan, hey, good to see you, buddy. Offshore trust, personal 1040s require checking a box saying whether you have an interest in an offshore trust. Do CCorp offshore trust sidestep this requirement? CCorp offshore trust income is not reportable to IRS until repatriated.
That's a good question. I actually don't know off the top of my head if that is indeed the case. There might be a case where the C corporation can't have an offshore trust.
Yeah, Dan, that's a better question for your attorney and your asset protection side of things. Okay. All right. Let's see what's my questions here in the chat room. Okay. Let's see here. Jack asks, how is Social Security payments treated? Is it earned income, unearned income, other, or Social Security payments received, basically?
So Social Security is generally going to be considered earned income for the most part.
Okay. Cool stuff there for you. All right. So one of the things that we like to do, what's your biggest pet peeve? I know I've already asked this question beforehand, but I want you to bring it up here today again. What's your biggest pet peeve when you're working with clients?
We're working with clients. Biggest pet peeve. There's a few pet peeves I have. One of them is they don't want to be proactive with their situation. That's one of my pet peeves. They want to reduce their taxes, but they don't want to do anything different, right? They always say, you do the same things, you get the same results, right? So if you want different results, you have to take different actions. And that's why, with the advanced strategies that are really powerful, some people are like, I don't want to do it. I'm like, I think that's what I brought up on your podcast, the coaching aspect of it, right? Like if you go to a coach and, say you go to Scott and Scott's telling you, okay, well, to, purchase these commercial notes, you need to go, I don't know, speak to this bank or go message people on LinkedIn and go talk and develop these relationships. And you say, well, Scott, I don't want to do that. Well, then how are you ever going to get into the note investing business, right? And it's the same thing with taxes. If I say, hey, look, if you want to reduce your tax liability, go explore the idea of the CCorp blocker, or go, discuss with your spouse about a way you can become a real estate professional. And they're like, no. Well, then it's like, well, what do you want me to do?
Right.
It's like going to the doctor.
Wave a magic wand. I want you to give me the blue pill or the red pill, and Morpheus show up.
Yeah. It's like I always say it's like going to your doctor giving you medication, and then you not taking the medication, and then going back to the doctor and say, hey, doctor, I'm still sick. You didn't help me. Well, did you take the medication I gave you? No, doctor, I didn't. Okay, well, there you go.
Exactly. Now, I think you also said one of the biggest mistakes you see people making is they cash in their IRAs or self-directed IRAs. They don't have a self-directed IRA account. Is that correct too?
They don't. Yes. So another big thing is some people will say, okay, should I just cash out my self-directed IRA now, or my IRA or my 401k, and take that money and invest into real estate, whether it be notes, whether it be rental real estate, whatever, right? That's the issue. And what happens is when you take your money out of your IRAs or your retirement accounts in general prior to maturity, you're going to be taxed at ordinary income tax rate, and you're also going to be subject to a 10% penalty. And generally, because you have so much money in your IRA, in those retirement accounts, hence the reason why you want to take it out, you can often put yourself into a higher tax bracket in that year you pull the money out. And when you pull that money out, you're setting yourself up for failure. I mean, I just ran this test the other day for a client who was actually in a tax-free state, and his income tax. Well, was he in Texas? No, he was in Ohio. So his total tax rate on his 401k withdrawal would have been 50.3%. And you're talking about, I think, he had hundreds of thousands of dollars in his account, right? And if you're going to take out that amount of money, you're cutting your principal in half. You would be better off self-directing the money and just investing it, because even if you were to be subject to UBIT, something that some people are concerned about, depending on what type of investment you're making, you're going to be taxed a bit on the returns of your investment, not your principal. So the bottom line is, for the most part, it doesn't really make sense to cash out your 401k unless for some reason you're able to do it when you're in a very low tax bracket, or perhaps you're a real estate professional and you can have some type of losses available to you to offset the ordinary income generated by the withdrawal of your 401k. So it doesn't make sense for the most part.
Well, that's the thing, is cashing out when you can still use it to invest with. You're taking such a huge hit right off the bat. Doesn't make sense. Okay. Let's see. Todd Silverstein has a question. He says, there's an old joke that goes, patient, doctor, it hurts when I do that. What should I do, doctor? Don't do that. Please pay the front desk. Thank you. We'll see you in 6 months.
Yeah, it's another good doctor joke.
Well, and the thing is too, if you start looking at some of the things, like, if you're putting your money into a self-directed, let's just say a Roth IRA, it's roughly, you're talking roughly $500 a month to hit your $6,000 contribution. If you're looking at your, what was the solo 401k, $56,000 you can contribute? Is that correct?
Yeah, for these $56,000, it's going to be $19,000.
Like, just under $5,000 a month, basically. Now, if you're making good money, hey, great. But do something between those two. You know what I mean?
Yeah.
Get your kids started early. If you can put up to $12,000 away, that's $1,000 a month. That's $250 a week. Yeah.
There's another good part of that strategy too that I actually forgot to put in this presentation. That I think about it. When you pay your kids, right? Your kids now have earned income. Now you could pay you can have your kids manage social media for you. You could have your kids file paperwork for you. Clean your office, whatever you want to, whatever they're capable of doing, you could have it. Now that they have earned income, they can open up a Roth IRA. Now this is going to get more into the financial planning aspect of things, but because they have a Roth IRA, you can contribute that $12,000 onto the $6,000 of their $12,000 into the Roth IRA, and you can invest it into, if you self-direct it, into anything you want, whether it be notes, real estate, or you just want to put it like an S&P 500 index and just have it sit there. You're starting your child out with a significant advantage, because if your child's, I don't know, the age is, I'd say, 8 or 10, right? You're looking at that many more years that child has to compound that money within that retirement account. And if you ever looked at like some of the compound interest charts or whatever, you could see that, if you start out a child that young, they could easily have many millions of dollars in their accounts by the time they hit, their 40s, 50s, 60s. So.
Yeah, I mean, when I was a young kid, I was mowing a lot of lawns and pulling a lot of weeds for about $1,000, every other week. Putting that stuff. If somebody had spent the time to teach me that stuff, it'd been a nice little chunk of change. I mean, I ended up paying for most of my school with what I saved and stuff like that. But that's the thing, is you could have somebody putting money into an ESA for themselves. Kid putting themselves to an ESA plus a Roth. That's $8,000 a year right there. They could put into it, correct?
Into an ESA.
Educational savings account, like a Coverdell.
Yeah, you could do this, the ESAs. I think some of the issues with the ESAs are when it comes like those, the 529 plans, is the fact that they have to be used for educational purposes. Yep. And if you don't use them for educational purposes, then there's penalties to get the money out. So it's an iffy situation, where we are in today's society. Is how prevalent is college going to be in, I don't know, 10 to 8, in 18 years from now, if you're just having a child, where some of the clients, at least that I've came across, are hesitant to put a lot of money into those accounts, because they're saying, okay, well, what if my child says, what, mom, dad, I don't want to go to college. I want to open up a business. Now they have all this money in these accounts they're going to have to pay taxes for, which is not that great. Where if you do the Roth strategy, which we think is the more favored strategy, you would take contributions out of the Roth at any time for any reason. So when they turn 18, they can get a job. They can pull the money out to start a business. They can use the earnings also the Roth IRA towards the purchase of their first home, as well as to qualified tuition expenses.
Yeah. I don't think you necessarily, like Marlene, I think Marlene said something here. What about an HSA for your kid? An HSA will work for the entire family. You can have one HSA that works for everybody. So you don't necessarily have to have separate HSA accounts for the kids, the parents, and things like that. Plus, they've got to have a major deductible insurance plan, which is basically what the parents are going to have to cover that aspect of things. So,
Yeah, absolutely.
let's see what else. We got some other questions here popped up. Sabrina says, if you move from an income tax state like California to a non-income tax state like Washington, yet you plan to rent your house in California, that rental income will still be taxed in California, correct?
Yes. And something else just to note there with California, you really have to be careful when you leave, and make sure you kind of leave as completely as you can, because California will come after you for their income and try to even have you taxed. And New York will do the same thing. I know if I live here in New York, they'll try to claim you as their resident as long as they possibly can. So
Exactly. Wayne Brindenstein asks, can you do the child deduction with a grandchild?
I don't believe you. I think it's only with a child can you get the tax deductions. You could still pay your grandchild. I just don't know, and it'll be tax free to them. I just don't know. Oh, it'll be tax free to them, but they might have to pay the self-employment tax on it because they're not the parents of the child, the direct parent of the child.
Levi asks, can you also gift your child the $14,000 a year tax free along with a $12K earned income?
You can gift your child the $14,000. I think it's $15,000 in 2019. But keep in mind that they can't put the $15,000 or $14,000 or any amount that you gift them into the Roth IRA. It has to be earned income.
There, such great knowledge in that head of yours, Thomas.
We have another one. Can your child be over 18? Yes, your child can be over 18, but if they're over 18, they're going to have to pay the self-employment tax.
Yeah, exactly. There. I know Linda wants to pay her son, who's like 35. No, I'm just joking.
Yeah. Well, no, I mean, so if your child's under the age of your child's under the age of 21. Oh no, okay. If
you have to claim as a dependent, don't you?
Yeah, I forgot the exact rules about the dependency. I know you could claim your child as dependent up until I think 26. It's just the 20. I think at 21. At 21, they have to pay a self-employment tax. That's what it is. 21, they have to pay a self. They have to, no matter what type of thing.
What other questions do you have for Thomas here, everybody? What are some of the things when people are looking to work with you? What's kind of? Can you walk us through a little bit of that? I get a few minutes still to spare. So kind of walk us through kind of that conversation and kind of what that looks like. Because we get so many people that, hey, I'm looking for a CPA in my business, but they want a bookkeeper and they don't want to pay. And I think a CPA can save you. A good CPA should be going out and finding you tax strategies that you can use in your business to help say that. Would you agree to that, Thomas?
Yeah, absolutely. And the problem is a lot of CPAs don't do that. They just file tax returns, which is okay. There's just nothing wrong with just filing tax returns. But really what you need is you're going to want to talk to a CPA who's going to come up with a tax plan for you. And what we do when we work with clients, a lot of our clients go through something we call a tax strategy foundation, which is a tax planning service that we have where we have multiple calls. So what we do is the first call, we really go deep dive into your tax and financial situation, really get a deep understanding of what you currently have going on. We discuss your goals, where you're looking to go. And then from there, we come up with a tax plan that's customized for you. We discuss, after we come up with this tax plan, we discuss this with you over a few calls. Kind of really just depends on how in-depth your situation is. And then at the end, we give you a tax blueprint. And that blueprint is a summary of all the strategies and what you'll need to do to actually implement them. Because what we found is we would tell people about the strategies. Like, here's the strategies. And then they wouldn't know what to do. So what we do is we actually give you the step-by-step as as we possibly can as to what to do to implement them. And then at the end, and then we're there for you year-round. If you have questions or need help, we'll make referrals to lawyers, to financial advisors if needed, to attorneys, and then work with them to make sure that stuff is being done properly. And of course, we file tax returns. I think we look at the tax returns as the necessary evil of the tax world.
Well, but that's kind of the first starting point. I mean, you got to look at what's coming in, what can you put away, what can you be deducted, and working your way there. But the first thing is sitting down with somebody. So many people don't believe they have anything that they can do, and that's not the case. There's so many things that can be just tweaked on your spending habits, tweaked on what you're doing to be putting money away into, whether it's a Roth, an ESA, it should say, or something, right, Thomas?
Yeah, I mean, there's the problem is with the tax code. There's a lot of things because most people never get advice. They're just missing. A lot of people are just missing basic things. I mean, we've done tax returns where people are just missing, like just on their rent. Say they have a rental property, for example, they just won't have their depreciation expense on it. They won't have their insurance on their tax return. That's just one thing. Then you have people who've never been told about the real estate professional status. You have people who've never been told that they could open up a solo 401k or use an S corporation to mitigate their taxes. And then you have all this advanced stuff, which is just available to people, and people have no idea. So, talking with somebody, or even just attending something like this, you're going to learn a vast amount of stuff and open up your mind to all these strategies that aren't necessarily there.
Yeah, they better be opening up their minds. I'm going to come across the camera and slap them in the face.
Oh, I'm sorry if you guys couldn't hear me. My fault about that.
No, you're good. Andrew asked a question: can regular self-directed 401k be converted to Roth without penalty through incremental annual conversions?
Can a regular?
That's it. I'm sorry. Go ahead, Thomas.
No, I'm sorry. I'm just trying to think through whether or not that can actually happen.
So I believe you can do a one-time conversion, if I remember correctly.
Yeah. So I think the way that it works, he's talking about a backdoor Roth. He's talking about a backdoor Roth IRA.
Yeah.
So if you do a backdoor Roth IRA, you need to do it all. I don't know if it could be done with solo 401ks, self-directed 401ks, to be 100% honest with you, but I know how it works for an IRA.
Yeah.
And an IRA, you need to do it all at one shot, like you just said. Like if you do it all in one shot, you don't have to worry. If you do it incrementally, then there's like a formula you have to use, and some of it, not all of it, is going to be. It's not going to transfer over so cleanly. So I would imagine if it's going to be something similar, if it's possible with the 401k, it's probably going to be a similar type of event.
Yeah, that'd be a good question for you to pick up the phone and call Rebecca Miller. Also, she handles a lot of those at Quest Trust Company. Rebecca.miller@questtrust.com would be a good email, Andrew, to shoot her an email. It's already sent you. Okay. Let's see. Question here from Marlene. Will long-term master leases over 3 years help with property management write-offs as if you own the property?
Not 100% sure on that one. I have to do some research on that one to be able to find.
Are you talking, Marlene? Are you the one that owns the property giving a long-term master lease, or are you buying a long-term master lease? Buying on a long-term master lease. So you're buying the property on a long-term master lease.
Buying on a long-term master lease.
So you're still going to have property management write-offs on a master lease, though, Marlene. Usually what's a master lease is you're taking it over, but it's like you're agreeing to still pay the owner of the property a monthly payment. So you're still going to have management costs and write-offs.
Yeah.
So.
Yeah, I don't see why it'd be much different than any other lease.
Yeah. So real estate pro status will apply.
Yeah. I think she's trying to get to the hours, like the material participation requirements. If you have a long-term master lease, as long as you're performing the rental property management work on the properties, like servicing the tenants, handling any repairs and maintenance, maybe you have a property manager on it, and you're working with them closely, then yes, it's still qualified. Just because there's a long-term lease on it and you're not renewing the lease each and every year, doesn't prohibit it. Yeah. So from what it sounds like Marlene's saying right here, absolutely.
Yep. Todd wants to ask your question, your opinion and stand on series LLCs.
Yeah. So series LLCs, they're a great tool depending on what state you live in. That's really from the series LLC sounds great because you could open up as many cells as you want. You don't have to file another article of incorporation. But from my experience, there's a lot of attorneys out there that don't like them. They don't like them because the Series LLC is not really proven. There's not that many tax court cases on it. Yes, and for that reason, they don't think it's very
enforceable or unenforceable.
Yeah, that's what they don't think it's enforceable enough. What the hell, man? My thing just went off. But yeah, they don't think it's very enforceable, and for that reason, they don't like using them. So my stance on them is it just depends on the state. If you're in a state like Texas, you're in a state like Wyoming, Nevada, Delaware, these can be great great things. Now, if you're in California, series LLCs don't make sense because you're still going to have to pay the $800,000 franchise tax on each cell that you open up. So, the one thing I can suggest for California, and some people don't like this one either. You could look into a Delaware statutory trust for California as an alternative to the Series LLC. There are certain groups out there that can put one together for you. Some people don't like that there's not that much case law on that either. But the reality of the situation is that might be really the only viable alternative outside of moving out of California.
Yeah, and so I've got a Series LLC, but I'm in Texas, so it's an aspect of things. And my attorney puts it together here, Scott Smith, here locally, has the same thing. Like, hey, why would it not be considered case law like a separate LLC? And yeah, it's early, but I would just talk about where you're at. If you're in a state that doesn't recognize them, then I would be looking for something like a Delaware state trust, like Thomas talked about. If you're in a state that has them, great. Talk to your attorneys here locally in the state that does it and go from there. Okay. Yeah. Good stuff. All right. So he goes, yeah, good. Toss is good suggestion on that. All right. Let's move on here. Let's see what questions we got. Lack of precedence. Yeah. Cool. Well, can you pull up your slide again with your contact information, Thomas, so we can go back to that, go back there?
And I apologize for running through this slide was supposed to be the last slide, by the way. I don't know why it came up first.
That's all right. So yeah, you get to realestatecpa.com, become a client, link there for you guys. You work with all types of investor types as well, whether in the note business or real estate. You work with people across the country, correct, Thomas?
Yep, all 50 states. We generally don't work with international clients though, just because of it's a lot of complexity. Deal with that.
Yeah, especially getting the money in the United States. That's the complicated part.
Yeah, you want to hear a funny story real quick? So we had this one client, a prospect, who came to us and says, "Look, I have it was like $12 million that was trying to get in from overstate." And we're like, "All right, we can help you. We know exactly how to get this money into the States. We can help you, but it's going to cost you like I forgot what the charge was to do it. It was like $5,000." And they said, "Absolutely not. We're not doing it." I'm like, we're telling you we can do this for you for $5,000. You got inherited $12 million. Like, you know what I mean? It's not like we're telling you it's going to cost you $500. We're telling you $5,000. Like, but that's just a funny story.
Cheap.
Yeah. I mean, I told him, like, if I had $12 million, I'd spend $100,000. I'd spend as much as it took because hey, $12 million is $12 million. But whatever.
You hear about the kid, the young guy in his 20s that won the Powerball, won like $300 or $400 million, and it took him a week or 2 weeks to come, out to claim it, because when we found out he learned that he'd won his stuff, he didn't come out immediately about it. He went and hired attorneys and lawyers initially to come in and help him structure everything properly, which is the best thing to do.
Yeah, no, I mean that's the smart thing to do. It's definitely a smart thing to do.
Yeah. All right. Any other questions? If people loved it, great presentation, great nuggets. Get some comments online here. People really loved it. Once again, go to the realestatecpa.com. Thomas, you or your partner will give people a phone call and touch base with them, right?
Absolutely.
So it'll be a Zoom and go from there. So any questions or comments before we let Thomas go for the afternoon and get busy on his weekend? Marlene wants to know if you have any more pet peeves about people.
Pet peeves. I don't know. I guess my biggest pet peeve is just in general lack of ambition. Just you need to get out there and get it. Man, you have one life to live. We live in America. We live in a time when there's so much resources available to you. We're sitting here on a virtual presentation where I'm in New York, Scott's in Texas. Everybody around here probably from other areas of the country. And, there's just so much information, so much opportunity. You really have to just go out there and capitalize on it. Some of my pet peeves, I see people who don't see that, who don't want to be that. I'm sure it's not anybody here. Everybody here is here.
Taking action. Yeah. Good stuff. Well, hey, man, thank you so much for joining us. We'll let you get rocking and rolling, all right?
Thanks again for having me, guys.
Thanks, Thomas. Hey, thanks for making it interesting, making that dry subject interesting.
Thank you. Thanks.
All right. Yep. All right, guys. That's going to wrap it up for this session here at Note Camp. We're going to take we wrapped up a couple minutes early. So we're going to take a 20-minute break and let you guys come on back for Corey Peterson, the big kahuna. That's like I call a buddy of mine that you're going to absolutely love. His topic this afternoon on some secrets to raising capital. And then also, multifamily capital raising secrets, things that he's doing to close some big deals. So we'll see you guys back in 18 and a half minutes.